Every month, we eagerly await the Fed's take on the economy. And historically, many have thought the government has the inside track in getting it right. But in a new note, Goldman Sachs finds that increasingly outside forecasters are closing that gap. As Goldman chief economist Jan Hatzius writes, the Fed's outperformance relative to consensus has declined over time. Even the inflation record is mixed. We welcome now Jan Hatzius back to Bloomberg. Welcome. So take us through this note. Why is it, if in fact it's the case, and you do a lot of sort of analysis to show it with graphs and charts and things, why?
I think it's basically because, it's always hard to forecast the economy. That's always been true. But historically, I think outside forecasts in the private sector consensus have had a pretty bad track record. There were a relatively small number of contributors, and there were some what we call noise forecasters who were consistently off by large amounts, and that really detracted from consensus performance. So the finding on data from the 1980s and early 1990s has been that the Fed staff really outperformed systematically, and recently there's just much less of a difference.
Does technology play a role? That is to say, do forecasters have access to more data more readily, instantaneously, so there's not the difference?
I think that makes sense as one potential contributor, and just learning about the structure of the economy. And if you have more forecasters, you average out some errors. So if you look at the consensus, one person being like wildly off on a particular theory, it just has less weight than would otherwise be the case.
So does it also make it appear like the Fed then is reacting more to market conditions than maybe it is?
Well, I think one implication that it has is that when the Fed lowers its view of the economy and maybe sends a dovish monetary policy signal, markets can take this more as just a change in the policy outlook, a dovish move, and something that actually should boost financial markets, and maybe not as much as a sign that they have private information about the economy, and we should all get a lot more bearish about what's going to happen. For me, that's actually the main implication, that if you think the Fed basically looks at the same kinds of things that we all look at, and we're all in a similar position in terms of our probability of getting it right, if they get more dovish, we should actually respond to that policy signal as opposed to get really nervous about something that we didn't know yet.
Jan, how does this read against what happened last December, where many people think there was essentially a 180 turn by the Fed in their attitude? Did they fundamentally change their views on the data, on what the data was showing, and what did the private forecasters say at the same time?
Everybody was revising down at that time, and that was true in the private sector, and I would say traders probably more than economists, more quickly than economists, but also the economists in the private sector and the Fed. The reason why there was such a negative reaction at the December FOMC meeting was that the Fed didn't move down quite as quickly in terms of their assessment of what kind of policy was needed as markets thought was necessary. And then subsequently, in the weeks after, the Fed made a much more aggressive shift, which then was taken positively. Eventually, markets said, they have recognized that things have slowed a lot and have therefore moved their view.